Hi, I'm Seth Freuberg, and I'm the Director of Options Training here at SMBU in Manhattan. Happy New Year, everybody, and good trading for all of you in the new year. Today I'd like to talk about an important topic which is very specific to options traders, and that is the trap that options traders will often fall into when they have adjusted a trade so much that it is actually not possible to make a profit on the trade as it's currently constituted. So this usually happens in a strong move in the market where the trader just cannot keep up with what's going on in the marketplace, and as a result of that you can get underwater on a trade, so much so that you actually will be incapable of making a profit for that expiration period on the trade. Now, when that happens, a lot of traders will look at the situation and say, I can't possibly turn a profit on this trade. It's literally mathematically impossible, but so I'm just going to end the trade right here and take the loss. With most forms of trading, that would be a logical decision to make, but with options income trading, it usually actually is an illogical decision, and I want to show you a good example of that today. Now, let's talk about options income trading a little bit and what you can expect. If you become a competent options income trader, you should over time be able to attain a return of 30 to 50% a year. Now, that's a big if. You've got to get competent, and that's not the majority. So assuming you put in the hard work and the experience and the practice and you get competent, that's a relatively realistic return. Now, so if you think about that, say 30% a year, which is an amazing return in most other forms of investing, that would be 2.5% a month. So if you were down, let's say 15% on a trade, and you could never make a profit on that trade, but reduce your loss from down 15% to down 5%, that is a plus 10% in your annual returns. If you took the 15% loss, now you've got to make up basically half of your annual returns before you get even. But if you take a 5% loss, it might take you, just a couple months to get back to even. That makes a huge difference. So one thing that options income traders often fail to realize is that reducing a loss is just as important, maybe more important, than increasing a profit. And so I'm going to give you a good example of that today, and I want you to keep this in your mind. So next time you get underwater on a trade and want to give up on it, you'll remember how much you're helping your annual return by staying in the trade and reducing your loss. So let's take a look right now at October 15, 2014, and what you see up on the screen now is the price chart for the Russell 2000 index, which had there was a precipitous sell-off started in early September, and by the middle of October, the Russell was down to 1050, like a 125-point drop. So let's look at what would have happened if on that day we had decided to put on an iron condor. And an iron condor, just to review, and this would be a December trade, an iron condor, to review, is a short call and a short put way out of the money, the short put way below the market, the short call above the market, and a protective long call and long put a little farther from the market in both cases, and that's what they call an iron condor. It's a credit spread. In this case, we received a credit of $1,650 for the trade, and this is eating up capital of about $8,400 or so. So what we're going to look at here is what happened after that, which is basically the market took off straight up and wouldn't stop. And that is not going to be good for an iron condor trade. So let's move to October 24th. And October 24th at 10 a.m., this trade had gotten to the point where we needed to do something because the short call at 1180 was really losing a lot of money, and we needed to get that out of harm's way. So one thing we could have done at this point, which is very common to options traders who trade iron condors, is to roll the call spread up. And in this case, we chose to roll it up in this hypothetical example to 1220, 1230 strike. You can see that we were in the 1180, 1190 strike on the call side and the 900, 890 strike on the put side. So we're going to roll this up, and you'll see that happen here on this next step. The 10-lot call spread was actually rolled up to the 1220, 1230 strike. Well, we took a realized loss when that happened, and now the trade is down $630, and the debit we had to pay to close that call credit spread was expensive. So we're now down $630, and if you look at the analyze screen here, you can see that that original $1,600 some dollars that we could have made on this trade has now dropped to only $210. The market moved up so furiously after we got into this trade that the best that could happen now on the trade is a positive $210. Well, that didn't happen, and in fact the market kept rallying. So on Halloween, at 10 a.m. on Halloween, October 31st, the trade now had gotten to the point where we have a loss of over $2,000. That'll come up on the screen here in a minute. Yeah, 2160. Now, against our capital level of $8,500 roughly, this is a 27% loss. Making matters worse, if you look at the analyze screen now, the best that can happen on this trade is to lose $1,450. So we're at a loss of $2,100. The best thing that can happen to us on this trade is to lose less. Now you would, and this is where I think it's critical for folks to understand. This is a key decision-making point for an options trader, and that is, do I just get out of the trade? I can't make any money on it. Should I just close it? And the answer is, in almost all cases, surprisingly, no. Because if you can get from $2,100 to $1,450, that's a difference of a 27% loss on this trade versus a 17% loss. That's a 10-point difference in your annual returns. That is very, very important. And so I would have advised anyone in this trade to stay in the trade for the very likely reduction of loss that will occur. And why do I say very likely? Because we have rolled that call credit spread out so far that the chances of the market just relentlessly rallying further, of course, are possible, but a little bit less than likely. The number of standard deviation moves from when we first entered the trade would just be too much for most people to reasonably be able to expect. So if we then move forward to and no further adjustments were needed on the trade. I looked carefully at this trade. If we move forward now to December 12th, which is just a couple days before the expiration, you will see that with really no serious danger after that point to that call credit spread, the market got to there's that call credit spread. The trade had gotten down to a $1,500 loss at that point, and if you just let this expire, you would have in fact had exactly that $1,450 loss. So simply by not giving up on the trade, you improve your returns annually by 10% versus what most people I think would reflexively do, which is, I better just give up on this trade. I can't make any money on it, so why stay in it? And there's a very easy answer to why stay in it. Why stay in it? Because you're going to improve your returns by a huge amount if you have some patience. Where a lot of people go wrong is they think that winning in any particular month is what the game is about, and that is not true. It's not true in any form of trading, and it is definitely not true in options income trading. This is a 12-month game. You look at your 12-month returns, and that is how you need to measure yourself. If you measure yourself against any 1 month, then you will make some very poor decisions in the long term. So remember, on an options income trade, even if you can't make money, you have to look at how likely is it that I can reduce my loss. And if the answer is substantially likely, then you should stay in the trade and get that loss reduced. It will help your returns tremendously over the long run. So thanks for listening, everybody, and we'll see you next week.